This is Lindsay McDougall on ABC Illawarra.
So if you own a home, how did you structure the mortgage in the beginning? Did you do that thing where you fix a portion of the loan, or have you kept the whole thing variable? Some financial analysts are predicting the end of the historically low interest rates we've seen lately, so the window to take advantage of them could be closing soon. But of course the catch-22 is that low interest rates have created a lot of demand and driven up house prices, so you could be paying low interest rates on high prices, but I guess that's better than high interest rates on high prices. So is there still time to refinance your mortgage and get a better deal? Well, first of all, any advice given is general in nature, and you should consult your own financial expert before making any decisions. But Martin North is from Digital Finance Analytics in Thirroul and is here now. Hello there, Martin.
G'day.
Nice to talk to you, sir. Let's start with the basics. Why would someone choose to fix their interest rate?
Well, there's a couple of reasons. One is that the rates that were on offer until very recently were better relative to the variable rates. But secondly, it gives you absolute certainty for the period that you fix. So if you fix the 5 rates, you know what precisely your repayments will be every month. And for many people, that's sort of a peace of mind insurance thing. So those are the two main reasons why you would do it.
Do people often fix the entire loan?
Sometimes. So, different advisors will tell you different things, and we don't give specific advice. But generally, if you are worried about rates going up later, then people tend to fix more. If you think there might be an opportunity for rates to go lower, but you still want some certainty, that might mean you split it 50-50 and lock in half, and then if rates do drop, then you've still got some variable exposure too. Although I must tell you that I think lowest rates have passed.
Right, interesting. Okay, so this this kind of ties in with what I was reading from Martin Wetton in the ABC article. The Commonwealth Bank's head of fixed income strategy. He said, "I fixed my rates at the end of last year," Wetton says, with a smile. So is that kind of where things bottomed out?
Well, I was saying up until about the end of February, where there were some very, very good low 5-year rates, never seen them as low. And at that stage, I was saying those seem to me to be too good to be true. They won't hang around. And now we're seeing that effectively those longer-term rates are the ones that are disappearing. You can still get a 3-year rate that's reasonably good, and that's because the Reserve Bank is handing spade loads of a very low rate money across to the banks to lend on. And so you've got this sort of term funding facility thing which goes on until June, and that's 3 years in duration. So that's why the 3-year money, 2-year money is still relatively cheap. But behind that, you've also got to understand that the old yield curve and interest rates are beginning to tick up a little bit. So longer term, expect rates to go higher.
So it is in what banks are being in a way subsidised to offer those 3-year fixed terms from the Reserve Bank, but it's not really going to. That's not going to last.
Well, that's really the point. So the term funding facility ticks over till June, and then they've got 3 years to pay it back. Yeah. But the bank needs to continue to fund, so they'll have to go to the bond markets or more deposits. Now, of course, deposit rates have been absolutely crushed, so in fact many banks are still able to generate very cheap rates for borrowers by stealing money from depositors, if I can put it like that.
So deposit rates have been crushed because people aren't saving as much anymore.
No. People are saving a lot more. So if you look at the relative distribution of deposits relative to other forms of funding like bonds, it's gone through the roof. So a lot of people over the last year have saved quite a lot more. Haven't spent as much, haven't gone overseas holidays, all those things. But the banks are actually dropping those term deposit rates and call deposit rates to close to zero.
Really?
So you get pretty much nothing on deposit these days. And that means that there's a little bit of wriggle room for the banks then to say, well, who do I want to target, right? So what they've been doing is targeting first-time buyers and people on fixed loans up to 3 years and offering them really cheap attractor rates. But then you've got to be careful because sometimes those rates then flip over to slightly higher rates later. So that's something to be aware of. The other thing I should just highlight is there's a thing called the apathy tax, right? A lot of people never worry about what rate they're paying, and people are still on 3-point-something and 4-point-something when they could get a 2-point-something, and that's costing an arm and a leg every month.
Apathy tax, I think, is not limited to just banks, probably limited to your telephone and data packages as well, those kind of things. Right, so
Well,
you should probably
it's
have
a sunny
a look.
day.
Yeah.
Won't bother.
Yeah, exactly right. We're having a lovely time here, but you probably could get a better deal on your home loan or what you're paying to your telecommunications provider. Right, so even if you don't want to, even if it's too late to get those fixed terms, even if your bank is only offering those 3 years, it might be worth being, because we have these historically low loans, to just have a little look-see and see what can be done.
Well, it's worth shopping around and look at not only the big four, because they tend to be more expensive, but look at some of the smaller organisations. Some of the credit unions and building societies actually have really good rates at the moment, and they've got a different funding model. But the other point to make is the Reserve Bank has said, look, the cash rate's going to stay low for at least 2 or 3 years. But the question is, will that automatically translate to no rise in mortgage rates? Given the funding thing I mentioned, there is a chance that we will see mortgage rates rise before the Reserve Bank moves.
Right, yeah, interesting. Well, Arvid's texted in from Kiama. Hi, Lindsay. Just refinanced the home loan, saved over 0.5%, and the new bank covered all refinance costs plus an extra $1,000 rebate for good measure. So a no-brainer, really. So there's a bit of that kind of deals going around at the moment.
They are absolutely desperate to steal business from other banks. So, negotiate hard. And also, I'll make the point, don't necessarily take the first rate they put on the table. Negotiate, right? People don't actually realise that they can still negotiate with their lender. So sometimes it's better to find out what the market offers, but then go to your existing lender and say, I'm going to switch unless you can meet or beat the alternative. And that's often the most cheap route at all.
Lower rates at the moment are driving demand. It's driving house prices up on the other side of things. Would the financial regulator need to step in if values continue to climb higher at their recent pace?
Well, they're certainly talking about what's called macro-prudential interventions. In other words, making the loan-to-value ratio limit drop so you have to have a bigger deposit, or indeed perhaps limiting some types of loans. But the issue this time is the growth is not in the investor market, which is what it was 2 or 3 years ago, and there was a lot of concern about that. It's in the owner-occupied sector and amongst first-time buyers.
Oh, okay.
And the other point there is that the Reserve Bank wants people to borrow more because it's basically the only growth lever they've got to try and make GDP go up. Right. So they're going to be caught between trying to make sure we get financial stability working the right way, but also trying to keep the economy booming, because basically housing lending is the only thing that's really booming at the moment.
So the only way to increase our GDP at the moment, this growth lever, is to get more people borrowing money. That's the only thing we can do to make our GDP look better at the moment.
It's pretty much plus what's called the wealth effect. So as house prices go up, people feel more wealthy, so they go and spend a bit more at the shops. But it is a fundamentally myopic strategy, which says it's all about what we're doing around housing. And unfortunately, if you look at our debt-to-income ratios, they're higher than almost anywhere around the world. The risks are rising. There is a problem with this strategy, unfortunately.
Absolutely. Martin North, thank you so much for cluing us in on all that today.
Good to talk to you.
Cheers. Yes, and as I mentioned, any advice given, general in nature, although very interesting, I have to say, and you should consult your own financial expert before making any decisions, but don't let the apathy tax get you. I think that is an important takeaway, and thank you for Arvid as well for bringing in a nice piece of information there.